downward bias. Samir Arora joins us now. Let's take the conversation forward. Samir, good morning. Thank you for joining us. If I look at what is happening in the world versus our markets, we are underperforming. Do you think the underperformance is here to stay and it's real?
Yes, it is here to stay and real, and our benchmark should be only whether our equity markets beat our fixed income markets for the local investors. But the fact that they will underperform US market for this year, I think, is more or less a given and now widely expected. And reasonably so. So,
going through these bouts of... No, I missed you. Please go ahead.
I was only saying one reason for the market per se is that we don't seem to have clear beneficiaries of this problem, unlike the US, where you could say Amazon is a beneficiary, Netflix is a beneficiary, Google maybe is a beneficiary, or some pharma companies who are actually finding COVID-related issues are clear beneficiaries, or gaming companies, or Zoom. India does not seem to have clear beneficiaries. Maybe we can say Bharti and a little bit Reliance. But for others, we are only looking at what is less badly affected and less affected, but not positively affected. We don't have that breadth of companies which you could say are benefiting from this.
So what does do in this kind of a market? You know that on the economy, things are going to get bad. We are in for the worst GDP growth, worst contraction in the history of India. Stock prices or companies where there is going to be a little bit of continuation, like FMCG, IT and pharma, those stocks are already richly priced. How does one go about investing in this market? Because one side you have to fight fundamentals, other side you have to fight the Fed. So who will win the final battle? Those who are fighting fundamentals or those who are fighting the Fed?
No, so there are, for an Indian investor, there are two things. One is that his equity should beat debt. And B, also believe in the history of markets, that markets themselves, because they are forward-looking and that they are discounting mechanisms, you need not totally panic at the bottom because things look bleak, because things have a way of turning around, or new sectors emerge, or new stocks emerge. Like in India's case, suddenly now Bharti and Reliance seem to be leading, who maybe 1 year ago, at least Bharti, nobody was buying. So you will have markets in the end reverting back to history, where, because they are forward looking, 6 months later we'll say that the economy has turned up from the bottom, that as the opening is happening, the GDP, which was down 45%, next quarter might be down 5%, and after 1 quarter flat, and the markets will look forward. So therefore, the idea is that you can take your time in making new investments, you can choose new stocks, you can choose new sectors, but broadly the lesson of the last 100 years across markets is that you don't leave the market per se and try to say that I know something which others don't. But broadly it is true that India has less room for both fiscal and also the attitude towards the corporate sector, in terms of trying to support it aggressively, which is what the US is doing. Plus, because US has a different mix of companies, and also technology companies and gaming companies, and these in-home beneficiaries where you are spending more time. All those things India doesn't have. So that is why India is underperforming. But per se, it will do okay compared to the choices that Indian investors have.
This entire narrative, Samir, which everyone has that time to go underweight on financials, they are over-owned, they are owned by institutional investors, they have redemptions, they are checking the exposure. Do you think now one should seriously look at reducing exposure to financials, and especially banks also? And I'm talking about the good old HDFC and Kotak Mahindra banks, which have created a lot of wealth for shareholders?
Yeah, so we don't believe so. Just let's look at big picture. So when a stock falls by half, you are basically, and for say a 1 year or 2 year bad earnings, nobody's saying that they will make losses. as a company. They may suppose their earnings growth is zero, or even if it is minus 10% for 1 year. Nobody's imagining more than that. So what happens? You are basically written off 50% of the company as if the company's life was 2 years and your 1 year is bad. Also look at it differently. If a stock is down 50% and another stock, say a consumer company, is up 20-25%, that means the consumer company now is worth 125% more, because this 100 has become 50 and the other 100 has become, say, 125. So 125 divided by 50 is the new relative valuation. But we have also not bought new financials, basically because we've always had, and in fact we've also reduced, not last few weeks but in the last month and a half, some of our NBFCs and even to smaller banks that we had, private sector banks. But I would say that at every point to say that it will underperform because it is overowned and underowned, if it did not underperform for 20 years while it was always overowned, that story is just excuse. But everything has to be done with discipline now, because that massive sector run that was there is over. But stocks still do well, as we have seen in the last 3 or 4 bull markets, that in every bull market that I've seen since 90s, the private sector banks, although they started only in 95, 96, but in all the 3 bull runs, they outperformed. JP Morgan has done the same in US. So the good stocks will do well, but there's no need to jump in today. You can take your time for a new investment. But to run away and say that now I'll buy something which is up 25% because this quarter people bought because they were sitting at home, so they ate more chocolates or they ate more something or the other, some noodles, I don't think that makes sense also.
Okay, fancy choices there, Samir. But, coming to the IT sector, I was just looking at some of these names. They're cheap as well, but clearly lack the spunk. We've not heard any innovation come in from our IT majors. I mean, when was the last time any of the IT majors announced and built platforms like even a Zoom or, for that matter, a house party or whatever have you? Because clearly our needs of technology are changing and so is dependence. Do you think the Indian IT sector can really try and grab a share of the digitization that we're going to see world over post-COVID?
Well, they haven't shown any such initiative before. So maybe the only thing they can do is help US companies, because Indian companies won't hire them. They can help US and global companies adapt to how to work at home and how to make the system so that the employees are all over, and you need to have security and safety and whatever else, controls, how you can monitor them. So those kind of things the Indian companies may do. And maybe when TCS says that we will have X% of our employees working from home, that will be their model to then sell that service, or maybe they're already selling it to others. But to have true innovation in terms of creating new products and all, it's like saying that India should do this and should do that. We bet on what will happen and not what should happen.
Sure, fair point. On the chocolates and noodles that you were talking about, Samir, we're consuming data and we're consuming food. That's all there is during lockdown, and I think for a long time, even post-COVID. But the fact of the matter is that consumer companies are trading at 60 PEs. Do you still venture out and buy them afresh?
Well, some of them we don't, basically because, if you are doing basically stocking up, then that itself affects the next quarter. Secondly, what is your of course, we have many consumer companies, but I'm just talking in general about the super high ones. Because the idea is that what is your scenario for the future? That we will always be like this, which always means, say, 8 quarters, which means that you will only be buying food at home and eating at home, which means the overall economy will be down, the markets will be down, and these stocks may outperform but are highly unlikely to really make you money even more than interest rate. Or you are thinking that the economy will settle down in terms of bottoming out and then move up, and then by definition other sectors which have been beaten up more and where the delta will be higher will outperform. And also we have already seen that for this quarter, in April and May so far, they are unlikely to have got any great sales because the old sales which were in the pipeline are gone and new production has not happened and the lockdown is not lifted. So this quarter anyway is going to be a disaster when the results come out, and that may disappoint many people.
Sure. Samir, everyone's been trying to grapple with where will pent-up demand be unleashed? Where will we see vengeance buying whenever it comes back? You've got the aviation sector opening up from 25th May. And by the way, the middle seat will not left be vacant. That will also be occupied. And clearly, you're seeing these sporadic bounces coming in aviation stocks. That we've seen how multiplexes have been beaten blue. We've already seen two of the large movies choosing OTT platforms as opposed to theaters. Having said that, some of the QSR companies have actually reported decent numbers, and they've got very positive management commentary as well in the quarter gone by. Where do you think this pent-up demand will be unleashed, or do you think it's going to be restricted to consumer goods?
I think the pent-up demand will be only for the first 1 or 2 or 3 weeks, depending on each sector. But the overall demand has to be down because of A, loss of jobs, B, cutting of salaries, 3, closing down of many small businesses, restaurants and all, who are not just selling you products, but themselves are consumers, small businesses. So I think the pent-up demand will mislead all of us, because in the first 2 weeks or 1 week, you may find all of us wanting to go out to see what is happening, and then maybe because of some second wave, or even otherwise because the nervousness is not over, the pent-up demand should not be viewed as a predictable future immediately, is what I think. Because the first round, there will be people who have money who will say, I want to buy a second car for my kid or for my wife or for myself or whatever, or for my husband. But this will be the first wave of people who have the money and who have the frustration that they want to go out and do. But the rest of it depends on the economy doing well. So I would not bet on the first 3 days of people going to a movie hall, or first 3 days or 20 days of people going to a airline, because they may be stuck up in one city where they were supposed to be in another city, and they will go back and pay even whatever ticket, even if it was not capped. But that does not show any consistency in demand coming back, according to me.
So, Samir, if one looks at the experience of Korea and China, where the Chinese are claiming that car sales have normalized, Koreans are saying, look, car sales have normalized, luxury car sales are back, the Disneyland has opened, it was sold out. You will not read too much into that.
So first of all, please note that in China, one city called Wuhan was locked down, and the rest of the country was not locked down. And they have not lost as many jobs and as many businesses and as many because they was not locked down. It's not that I'm saying that lockdown is good or bad, but the fact is that in reality, we have had so many losses in jobs and all that. How can this come back? From where does it come? Because in any case, over the last 1 or 2 years, or even more, the Indians were earning less in terms of incremental and spending more, which means they were reducing their savings to consume. And now when you see this, you will for the first 6 months not to be sure. So we cannot connect. For example, in the United States, the people who've lost their jobs, more than 50% of them are currently earning more than what they were earning in the job by just the unemployment money that they're getting. This was an article in Wall Street Journal about 2 weeks ago, and you can search for it. But basically, it was saying that for the people who've basically been fired or furloughed, 50% of them are earning more than they were earning when they were in a job. So in theory, they are actually saving money right now because they are earning higher or equal to what they were earning, and they are not spending as much. So clearly, when the malls open, if they don't feel otherwise unsafe, they will buy, they'll spend, and then mostly they'll get their jobs back, because these are furloughs rather than permanent fires. In India, we don't know that. So I'm saying, take time. I am not negative on India. My fund runs on India, and I sell India. In fact, today afternoon I had a call with a foreign investor. But the point what I'm saying is that today, to conclude that this is what happened there, that we are underperforming for a reason. So let us not draw every conclusion that because Amazon has a good result, therefore NASDAQ goes up, therefore the US market goes up, therefore next day we have to go up because overnight the US was up. They're different stories.
So, okay, Samir, on the way up, we've underperformed the world. On the way down, are we likely to outperform because A, we've fallen, B, if one looks at the US market also, Samir, I understand the Apples and the Amazons of the world are taking those markets higher, but the US economy also is going to contract. So my point is that on the way up, we are underperforming, but on the way down, are we likely to outperform?
So while you say way down, I am not saying that the market is going down. I'm saying it's not easily going up. I'm saying that if the US market goes up, we'll go up a little less, but we will mostly go up more than what the investors can earn in their debt and other investment. I'm not saying that we have to go down more or that the US is going down. I'm just saying that this idea that this pent-up demand will help consumer, I don't think that is the case. But does it mean I have no consumer? I have 20% in consumer. You broadly buy the stocks that you like and have them. Don't overly believe in this quarter story and the next quarter story. But don't also believe in buying stocks which are up 25-30% in an environment where the market is down 25-30% on the logic that in this quarter somebody bought my consumer item. That's what I'm trying to say. I'm not betting that the markets have to fall a lot, and in that whether we'll outperform or underperform. I have no basis for that. In that sense, things are improving. Hopefully there will be some cure, some vaccine, and then people will even look 1 year forward. But all I'm saying is that just because somebody had a good March quarter doesn't mean a thing according to me. Because A, it was 5-10 days of the lockdown, and B, relative to the market, it makes no sense to be buying those stocks as if there is some value in a stock which is up 25-30%, while the market is down 25%, and where even those stocks will have bad quarter, at least this quarter, if not forever.
Absolutely. Samir, there has been such a bearish tone, from some of the veteran investors with regards to what we're seeing right now. Is it a case where you feel that we all know that, the industry is unhappy with the kind of package that was announced? Is it a case that the government genuinely doesn't have the ammunition? Or is it a case that they're just being apprehensive about the fisc and future borrowings, and they're not actually putting down those financial packages, a clear financial stimulus on the table, whether it be bailouts or cash infusions, recapitalization? Is that going to be the need of the hour? We're watching out for the RBI commentary in just about half an hour, but how much ammunition is left for them?
The first thing is that I don't know which veterans you're talking about who have come on TV and said that they are unhappy. I don't know any. But in general, I would say that it is also a philosophical issue that I think somehow this government feels that the corporate sector, the business sector, the investor sector is somebody who's taking advantage of the country or other citizens or whatever. There is not that feeling that we are here to protect businesses, that if we are talking to business, it is not some shady thing that we are talking because businesses are an important part of the economy. Here we don't get that feeling, I think. I'm not a businessman, but in that sense, but I don't feel that the government or the system at a large thinks that these businesses need to be supported that actively as it happens in the US. And that is why the US market gets the support in bad times quite openly. Whereas in India, it has to be, put as part of a package. And the business per se is the last one to be bothered about.
Right. So certain pockets, like, okay, let's talk about real estate that were already reeling. Given the current scenario, there's no silver lining for them. We're also heading into the monsoon, so even if we take a look at pockets like infra, construction that are just about seeing a resumption, some amount of activity coming back on stream, are again going to have to pause. This is all just going to delay the impact of what we're seeing, whether it be on the economy and in turn, ideally, on those stock prices.
I agree, and therefore, we basically invest only in three sectors, which is financials, consumer, and tech pharma. Now you can say, as a big picture, and once in a while now we have both these telecom stocks. But in general, the idea is that you should not be relying on government revenue, government policies beyond a point. Although today everybody is looking for a government policy or a government bailout or a government help. But that's what I mean. This is a philosophical thing. Somebody can say, oh, you always liked private sector companies. So now suddenly with the private banks are in trouble or going down, you want the government to not directly help them, but help the borrower, help the MSME, who can then pay off the private sector bank. Now, these are all philosophical issues because in the United States, all the companies are private. And therefore, everybody by definition doesn't have to care whether he's buying private or public, he buys private companies. But in a bad time, the government knows that at that time it must help. And in return, in a good time, they will get it back via taxes and employment and then taxes on the employees. But here somehow, on a bad day, suddenly the public gets up and says, aha, Mr. Arora, every day you only wanted to buy HDFC Bank and Kotak Bank, and now you want the government to help these private banks, and maybe they should only help the state-owned bank. It's a philosophical thing. And for this philosophical thing is why the Indian market to a totally macro guy would look less attractive than the US market, because there is this thing where on a bad day in the US, they will come out and try to help. It may not work, it may be wrong, but from their side, they will try and help. And that doesn't happen here. Now, coming about to your real estate sector, there are so many issues right now, whether this work from home will work. If work from home works, then that means the employee does not have to be living in a big city. Why does he have to live in Bombay? He may be staying in his home city in a slightly smaller place. I mean, a bigger house for him, but in a smaller city. And therefore, so many things will change that nobody knows about all these things. We know basically that you will still need financing, you will still consume a little bit. And this IT is more of an export kind of thing that helps. But beyond that, there'll be massive changes, and we can buy a little bit here or there. So I only say that nobody should come today and say, I'm so excited by only looking at the prices. I'm so bullish. The correct answer is, it is uncertain. We are doing the best we can based on good quality companies and history and valuation. Mostly it will do better than your other alternatives. But please don't tell that, put everything today because it's the best time, that, whatever happens, India will outperform, or whatever happens, equities are the best. But generally the history is like that, and you have to view it accordingly, with a little bit of humility.
What could really lead to downside? Will it be selling? Will it be, more and more bad news coming on the economy front, on the growth front? Because by and large, everyone is of the view that FY21 will be in washout year, and sensible, investors like you've already, been taking a lot of risk management, and you've not been taking undue risk in the portfolios. So you've always maintained, Samir, that don't look at the news, try and figure out how much of the good news or bad news is in the price. The fact that economy will slow down, we will have no corporate earnings this year, credit is going to be in problem, banks are not lending, corporates are not doing well, MSCs are in trouble. Isn't that consensus and general knowledge now?
No, it's not. If you look at the earnings growth for this year, they're still quite high. But the problem could be, first of all, not knowing how far this will continue. As in, what if when this opening up happens and there is a second wave? We don't know. Or what if one or two at that time, like today it's Moderna's vaccine, but let's say whoever, maybe it's Moderna only, somebody's vaccine goes to stage 2 and then it fails. So that kind of disappointment will be considered bad and will bring down everybody's sort of bullishness, or whatever is the word, their optimism. So it's those kind of things. And third is, as I said, that, for example, we don't know how many people are really paying their rent to the mall company, how many people are paying rent to the real estate company, how many small companies are going out, what about the privately, these new age companies in India, how many will go under? These are the issues. But if these issues are solved, they will not be all solved overnight. So slowly, as you absorb this, you can increase your equity allocation a little bit, or average more, or whatever. Right now, I'm only saying one thing, that we all keep saying that market timing should not be done. I think with new money, you have to be a bit comfortable to invest. There is no need to say, since I don't know, since somebody told us that timing is not right, as soon as I get my salary next morning, I'm supposed to invest because people said that you can't time. You can't time, but it's a psychological thing. So I'm saying relax, which I said last time also on your channel. Just relax. Whatever is invested, you juggle it around if you want, or still let it be, or change the stocks, because stocks need not outlast you, but market will outlast you. And then with new money, be relaxed and invest slowly. Nothing is changing so much in the next 1 to 3 months that you would have missed a massive rally or something.
Assuming that what I can see on the television screen is your backyard. Now it's a good time to perhaps wrap our today's conversation with some magic tricks. I mean, let's talk about something, because everybody needs magic in this painful environment. So any new magic tricks or card tricks you would like to share?
Yeah, but I'm not ready, but I can on Saturday. These things should not be done Monday to Friday, because my investors also look at my tweets and they look at my interviews, and we don't want to give them the impression that I'm doing these things on weekdays.
It's a long weekend this time, so what should we expect on Tuesday morning on Twitter then?
Before Tuesday, you mean? Okay, I'll send you a magic trick. There are many in my mind that I have learned from YouTube.
All right, I look forward to that. All right, Samir, thank you for joining us, and always such a pleasure to get your insights on markets and what's happening to the world, and I look forward to that magic trick.
Okay, thank you.